My name is Martin Massey. I chair the IRM Climate Change Committee. And thank you all for coming for this joint event between the Institute of Risk Management and PricewaterhouseCoopers. We have a lot of people who have decided to join online, so quite a sparse number of people that have attended to date, but I think it's still people coming in. So we'll kick off anyway. And we'll hope that people attending will stay on for the networking event, which we'll have afterwards. There will be a survey afterwards, and the fathers here from the IRM has told me that they'll send out a survey after the event. And I'd like to thank actually Shiva and Stuart from PwC for enabling us to host the event, and also Natalia from the IRM for coordinating the event on behalf of the Institute of Risk Management. The topic today is focused on how the financial sector can build greater resilience to climate change, which is a complex subject, covers a range of risk management and business disciplines from both a physical and transition risk perspective across the existing and future risk profile of the organisation. Both have long-term effects, but also have disruptive short-term consequences. In terms of definitions, I was having a look around business resilience. It's really critical to ensure an organisation's ability to adapt, to withstand emerging trends. It's very much focused on emerging risk management, unexpected events, as well as unexpected developments, plus the various aftershocks or implications. It's very important to look at the knock-on effects of those events in the organisation. So planning is really, really key. My clicker, maybe you can share with it. So in terms of the agenda, we have a good balance of speakers for participating across different perspectives on the subject. We've got latest regulatory expectations from Alistair from Bank of England, to a practitioner's perspective from Susan, CRO in the insurance sector, and also she's also a member of our IRM committee. Myself, Stuart and Gethin will provide some latest case studies from both the banking and insurance sectors using a range of risk management tools and techniques. In terms of timing, we do have a sort of a packed agenda in terms of content. So I suggest we limit questions to only 1 to 2 questions after each speaker, or we can leave some of the questions towards the end. And the idea is to sort of finish the presentations around 5:15 to 5:30. And we can break out some drinks afterwards. We'll be available for answering any questions at the end. For all those that don't know, the Institute of Risk Management is a leading professional body for enterprise risk management. The IRM provides global recognised qualifications and training, publishes research and thought leadership, and sets professional standards, has been building a global community through special interest groups and regional groups. And I've been involved in a number of those groups. When I was actually working in Qatar, there's a regional group in Qatar. There's quite a lot of activity now in the Middle East, in other parts of the world as well. But also special groups that focus on particular risk topics like cyber risk or ESG and climate. So the idea is that as we are those sort of specialist groups, we reach out to other committees across the world to basically share knowledge and experiences. I was part of the innovation group, and in 2018 we actually wrote a guide on horizon scanning, which actually at that time that concept wasn't very well known, and I think a lot of companies have adopted that as a sort of a practical process and tool to help scan the horizon in terms of looking at emerging risks and building resilience. So in terms of the IRM SIG itself, it was established 3 years ago. The climate change SIG was established 3 years ago, and the main goals were around thought leadership, which have included organising webinars, surveys, and we also started developing a newsletter, which I think has been really helpful to support knowledge sharing. 2 of the achievements that we set out were to develop a training course in climate change, which we launched in 2021, and also practitioner's guide, which we also launched in 2021. We're also supporting the IRM's risk trends report. So there's an annual risk trends report, which was published actually this year in March. And in terms of, so what happens, each of the risk committees provides input, chairs of those committees provide input. So in this year's report, we focused on looking at areas such as increasing regulation reporting requirements, increasing climate litigation, regulatory sensitive, greater need for comprehensive climate data, which I think we'll touch on throughout today, which is obviously one of the biggest challenges for organisations, getting good data, and focusing on resilient strategies due to extreme weather events, which is becoming more and more problematic as we've seen over recent years. We plan to hold another event in June. I'm working with the ESG committee and also the Midlands group to look at climate governance. So that's obviously quite an important area of focus. We'll have a separate discussion. Now we'll come back to some additional slides that I'm going to cover, but for now I wanted to pass on to Stuart from PwC, who will set the scene in terms of looking at the latest science around climate change. So I'll hand over to Stuart.
Thanks, Martin. Thank you. Right.
Trouble before.
Right. So I'm good afternoon, everyone. I'm Stuart Combs. I'm a partner in PwC's financial services team. I lead financial risk modelling across the UK, with particular focus on the banking sector. I've been working in the area of climate change for maybe the past 3 years. The main area of focus has been on supporting clients on a number of areas on baselining their emissions, supporting them on climate change stress testing, and more recently it's been around supporting them on determining their transition plans to achieve their climate targets. To talk today, what I intend to kind of cover is really kind of to set the context, and Martin really kind of asked me to set the context of why we're here today. So I'll discuss the risks that climate change pose to the global economy and in particular the FS sector. And then I'll cover what changes we need to make to become more resilient against climate change, because that's ultimately the topic there of climate resilience. Right. So I thought I'd start with some statistics and some punchy statistics on a slide. The 2.9 trillion. 2.9 trillion is the historic cost of climate change over the last 2 decades. And this is a number that's come from the United Nations report back in 2020. And what it says that over the period from 2020 to 2019, the year 2000 to 2019, there were over 7,000 major recorded disaster events affecting over 4.2 billion people and costing the global economy 2.9 trillion US dollars. Put that into context, the World Bank's most recent figure on UK GDP puts that at $3.1 trillion. So we're talking here of costs very close, actually, UK GDP on an annual basis. And what we've seen in terms of those hazards, they've been kind of broad ranging, right? They've been earthquakes, wildfires, landslides, droughts, but in particular, there's been 2 types of events which are flood related as well as storms, which have been particularly prevalent. And over the last 2 decades, the impact of both floods and storms and those frequency and severity has increased significantly. So I guess the scary part is from the first statistic is that we're likely to see the number of 2.9 trillion increase over the coming years due to climate-related risks. In terms of the 39%, which is more of a business lens, this comes from the PwC Global CEO Survey in 2023. It calls out that 39% of global CEOs say that their business is moderately or severely exposed to the threat of climate change over the next 12 months. And given the long-term nature of climate change, we then understood that 30% of UK CEOs stated that they are implementing measurable strategies to reduce emissions as well as mitigating climate change. So lots happening in the business space. In terms of the 1%, the greater than 1%, this one comes from a UK government climate change risk assessment report in 2022. It identified a range of potential costly impacts of climate change, including impacts related to health and productivity, affecting a wide range of households, businesses, as well as public services. And that impact included things all the way from deterioration in agricultural productivity all the way to water supply management. And therefore, the report outlined that unless we take further action, cost of climate change to the UK economy could be at least 1% of GDP by the middle of this century. So there's, from a UK perspective, the risks of climate change are quite large. But then there's kind of an upside or a light at the end of the tunnel where we're talking about $7.1 trillion of investment benefit. And this has come from a recent report from the Global Commission on Adaptation. And that research finds that investing $1.8 trillion globally in 5 key areas over the next decade could deliver $7.1 trillion of total net benefits. So there's actually a 4x return on investments. And that very much speaks to the opportunity lens of mitigating the impact of climate change, of being much more focused on climate resilience. I guess before I kind of go through this slide in detail, what we've seen over the last couple of years is that the world has faced a set of risks that feel both new but somewhat familiar, and it's kind of a reoccurrence of older type risks, right? So we've seen inflation, cost of living crisis, trade wars, capital wars, geopolitical issues, and even bank failures. And these will remain the greatest risks over the next few years also. But what this slide calls out or shows is that the top 10 risks from the Global Risk Report by the World Economic Forum published in 2023. And these risks are longer term risks looking over a 10-year period. What's interesting is that climate and environmental risks are the core focus of the report, and so they equate to 6 out of the top 10 risks over the next 10 years. And to some extent, these are the risks for which we seem to have the least preparation on. So we really need to be taking action now to address these risks. However, considering the immediate risks, as I called out, there seems to be a reduction in speed and scale of mitigation efforts on climate change, and just as likely that the amplification of risks associated with climate change will even become more amplified in the future. I thought I'd put some headlines on climate change on the screen. I'm not going to go into in significant detail, but just to call out a few, as in key theme really on the slide is that the FS sectors is key to financing the transition to a low carbon economy. And that's really called out by Deutsche Bank from COP27. We then have an article from the FT which calls out that we need a catalyst to push the agenda on climate change. And that catalyst is, as they call out, is carbon taxation. But then importantly, when I bring it back to kind of the FS sector, there's a bit of a profit warning from the Bank of England, where post the CBES, the Bank of England has estimated that banks and insurers that fail to mitigate climate change risks could face 10 to 20% hit on annual profitability and potentially lead to higher capital requirements. So the big takeaway from this slide is that more focus is needed on climate resilience and protecting business models, and it's likely to come in the form of either higher capital requirements or carbon taxation to come down the line at some point, or potentially both. I'll skip this slide for now, but what I wanted to jump onto then is and where are we progressing in terms of where are we at this current point in time? So we know that the Paris Agreement expects us to be within at least below 2 degrees Celsius, potentially 1.5 degrees. Our current trajectory based on PwC's Net Zero Economy Index from 2022 indicates that we're on a trajectory of 2.8 degrees. And if we look over the last 20 years, our global carbon intensity fell by 1.4% on an annual basis average over a 20-year period. If we need to get back on track to get in line with the Paris Agreement at 2%, then we need to be decarbonizing at a rate of 6.3% on an annual basis going forward. Or if we want to hit 1.5 degrees Celsius, then we need to be on a trajectory where we're decarbonizing at 15% on an annual basis. And so that there's quite a significant amount of action that's needed. In fact, delivering 77% reduction in carbon intensity over the next decade. So a lot to do. So what can we do about this? So FS firms are facing a wide range of stakeholder pressures to take action on climate change. There are pressures from customers, society, regulators, shareholders, investors, third parties. And then you have a number of major standard-setting bodies related to climate change, which are also pushing the agenda on climate. And so we have the PRA and NGFS, which are focused on climate scenarios, stress testing, as well as supervisory statements. SS319 is a common one, well known in the UK. We then have disclosure requirements from the likes of TCFD, SFDR, ISSB, CSRD. So lots of reporting requirements, disclosure requirements for firms. And then more recently, we have transition planning requirements from the Transition Planning Task Force. So the key action here for FS firms is to determine a credible transition plan. That's ultimately what it comes down to, and to report that to the market. And to do this, these FS firms need to build out a number of key capabilities. And that's really the stuff on the right, which is, first and foremost, it's about embedding climate change into your strategy. And what that means is demonstrating that your climate strategy is integrated into your corporate plan. And that will become very important when we come to 2030, when many firms have already set science-based targets. Secondly, it's around integrating climate change into your governance and operating model. Thirdly, it's about investing in data and where to source that data, and then how to bring it into your wider data ecosystem of your firm. Modeling will always play a part, and we see many different types of models: physical risk models, transition risk models, as well as emissions-related carbon accounting type models. And then finally, it's around reporting. So lots of competing demands, as I said, from many different bodies, but it's about being strategic about how you do that and building up reporting capabilities that all provide transparency, which also becomes efficient for the firm. I'll leave it there, as in obviously PwC has got a lot of thought leadership in the market, and you can search online and find much of that as you wish.
Very powerful introduction there about the challenges. So yeah, just going to sort of follow on. So I meant to sort of introduce myself a little bit more, but I suppose in terms of my journey in climate change risk management, I started about 20 years ago. Actually, in my MBA dissertation, I helped develop a hedging strategy for a major utility company in the UK. What was interesting for me then was that a lot of energy companies were very aware of climate change. So it's not a new risk, and actually they're also pricing in so that what we pay for our own gas prices was already climate change was already factored in 20 years ago, and that was something that I was sort of surprised me. And I think, but it's taken a lot of time, as Stuart was showing there. It's that a lot of regulators and stakeholder pressure is really what's driven the changes in the last few years. And we obviously have the Bank of England here today, and their excellent guidance that was provided in 2019 through SS 319. I have been fortunate in my career to work with some of the largest global risk organisations in the world, including Swiss Re and AIG. And AIG actually, I was on a global project looking at aggregation exposures worldwide, and that was fascinating, gave me a lot of insights into natural catastrophes, man-made catastrophes around the world. And at Swiss Re, who do a lot of research as well, definitely worth having a look online, looking at some of their reports. The recent report this year stated that natural catastrophe events are costing the insurance industry twice as much as they were 10 years ago on average. And that's a really, really quite powerful stat. And that's actually, the knock-on effects are quite important to recognise, because it's put a lot of pressure on the ultimate bearer of natural catastrophes, which is traditionally the reinsurance market. And that has ramifications in terms of pricing. If you look at rating agencies, 50% of their ESG ratings for reinsurers is actually physical risks of climate change. And a lot of that, as Stuart implied, are events such as tropical cyclones, floods, wildfires, etc. So a lot of, I suppose, climate events we've seen before, but actually there are sort of shifts and changes and patterns, both in terms of events, but also the types of risks affecting business. So more sort of chronic type of peril. So, as I mentioned with the utility fund, it was around looking at mild winters, but agricultural sectors being hit. So if you're obviously looking at your market risk exposure and your credit risk exposures, and you're looking at customer base, you've got to recognise that a lot of its sectors are being impacted by climate, as Stuart outlined there. I started my own business in 2020, and I was a CRO and part of a Lloyd's syndicate, and we did a very much deep dive in looking at climate change. And in terms of sort of advising and training companies, it's been really helpful to look at the external guidance from the likes of Bank of England. Last year, I was sort of buried myself in my study at home because I was commissioned by the IRM to write a book on the subject, which was quite challenging. And one of the tactics I used was actually to reach out to organisations like PwC, and we have Skyland here today to provide case studies, and I'll talk about that a bit more. Interestingly, the sort of research that I've done has actually helped supporting me now working with Cambridge University on their Advanced Online, so I think online training and ESG risk management, because there is a lack of sort of general knowledge out there of actually education and training. It's really, really important for practitioners. There's a number of publications that I've been involved with recently. I think this is not working. In terms of the book, it was published in December last year, Climate Change Enterprise Risk Management, Practical Guide to Reaching Net Zero Goals. And it was set out in 12 chapters. And really the focus for me was actually trying to help risk professionals integrate climate change into their existing ERM frameworks. And that's a big challenge. So there's a lot of talk around climate change, but it's the practical, how do you actually implement it? Also into business processes to support improved decision making, because ultimately in my career I've always been focusing on, well, how does it make a difference? How do we add value? In terms of developing climate strategy and plans, professionals need to support their organisation, applying expertise in aligning, influencing corporate ambition. So in the middle there, talk about setting the ambition for the company within the enterprise risk management framework. And the strategy needs to be underpinned by two fundamental components, as we've been hearing: resilience and sustainability. And the strategy needs to be ultimately to be embedded, needs to be dynamic, it needs to be iterative and responsive to change. So I think when a lot of companies have been setting up their climate plans, it needs to have the ability to keep being updated. So it's a journey, as we all know, in terms of maturity. As I mentioned, tried to integrate a lot of case studies into the book. The IRA have kindly said there's a 20% discount online today if you are interested. There's a few books outside, so that was part of the strategy today, sell a few books. But no, in terms of, on the right-hand side, you'll see a diagram that I actually spent quite a bit of time thinking about, which is around building, how to build resilience. That's just one chapter, which was primarily focused on physical risk. And what I realized is there are a lot of new tools and techniques, or some of them I've been around a bit, but it was almost realization that actually some of the traditional tools and new tools are really helpful, like horizon scanning, stress and scenario testing, stakeholder mapping is actually becoming a much more important tool for practitioners now. And really to look at the wide-ranging threats and opportunities over different time horizons, which is critical building resilience. Both from a strategic point of view, a financial point of view, and operational. I think there's a little bit of an over-emphasis on operational resilience, but actually, as we've heard, financial resilience now is a really, really important area, and the strategic side of it as well. So that's why emerging risk management processes are so critical. If you look at Swiss like the Swiss 3-minute read, and the amount of research they do on emerging risk is phenomenal with. And I think a lot of companies really underestimate the importance of that. Stakeholder mapping, as I mentioned, is a great management tool to assess stakeholder expectations. As Stuart mentioned there, you need to look at investors, your customer base, rating agencies, and employees as well, which is becoming more relevant now with younger employees that are really taking us more to heart in terms of both the ability to influence and to control. And this will lead to healthy internal discussions from what I've seen in organisations. And often there's therefore a need to sort of, potentially bring in external expertise, external advisory services. And back in the day, I used to involve, Swiss Re's head of emerging risk in projects that I was involved. Experts are really helpful in this area. Just on a sort of a basic sort of a tool, bow tie analysis, from a risk management perspective, is really helpful, especially when we're looking at future scenarios. Think about all the root causes, consequences, but then you overlay that with your control environment. And I think this is a piece that's missing. A lot of work in identification and assessment, but not enough around looking at existing controls, how robust are they, and therefore build effective mitigation plans. So here's one case study that I was involved with, and it's quite an important and relevant case study to this discussions that we've had. It's actually for a global insurer, and looking at some of the principles behind what companies need to do, and it's also relevant to other sectors. And the real challenge here was to develop a robust and usable physical risk stress test process to align to their operations around the world. So UK, Europe and the US, and there's obviously different regulations, but actually what was interesting was that the regulators are quite similar, and it was really to stress their individual also reports around the world. And the solution to the project was to utilise a 6-step process that we developed for scenario analysis. It was actually interesting. The Bank of England adopted this process. So again, a lot of trying to use existing processes that are actually make sense. And we worked with their global reinsurance broker to look at their CAT models, the CAT modelling outputs from RMS and AIR, etc., by peril, by geography. And the benefits of the process would really help stress test their solvency position for future discrete global climate pathways. And so, when I first looked at this, I always felt it was a little bit abstract, but I get the rationale behind it, because again, as Stuart mentioned, it's very much a long-term play. You have to think through, and the implications are quite interesting when you start to realise that, for example, maybe your flood losses as a global insurer might be 50% higher in 10 years. You start to realise that you've got to change your strategy and, for example, improve exposure management, look at concentration risk, think about your reinsurance strategy, etc. So it starts to realise that it's not going to be the same. And you can't rely on maybe existing control environment into the future. So another key challenge is briefly wanted to talk about, which is something I've been sort of more interested in more recently, is around, again, flowing through is to dashboards, internal reporting, external reporting, dashboards. As a CRO, I used to have to present risk to the board. And on the right-hand side, there are some simple visualization sort of tools out there, or ways that you can depict emerging risks, in this case, across physical and transition risk. And that's quite helpful in terms of thinking through both the risk impacts and over different time horizons. In terms of metric and targets, organisations need to design robust climate risk appetite strategy, and there's sort of an overall framework on the left. I mean, you can spend a number of years actually building out this across the business, but that's a very simple concept around ultimately you need to build out your risk principles, your metrics, high-level metrics like net zero targets, then your risk preferences, and then your key risk indicators. I think the key challenge, or one of the biggest challenges, is around monitoring. And actually, you need to almost back solve, and that's a really helpful exercise to think about building a dashboard of all of the KRIs that you need to manage your business across your risk profile. And there is a distinction between what I call key performance indicators and key risk indicators. All the companies are actually looking at activity levels, but that's not really helping. What you need to think through is actually how you're going to make decisions around the information from a risk perspective. And that's quite challenging. And you need to look at that going across physical and transition risk. So, for example, setting targets for carbon emissions, sustainable investments, credit risk management processes, supplier management, etc. So across the whole spectrum, and it's actually a really interesting exercise to go through and get stakeholder engagement from different parties in the organisation. My last slide really is just a quick summary of some of the enablers and benefits of building climate change resilience. I've been working, interesting, with some organisations where they realised that they needed climate change risk policy, separate policy, with, and also look at a risk register design. I mean, simple concepts really, but ultimately it's very helpful to start to actually make sure that you are managing your climate change strategy and into your existing risk management framework, and also to support business and strategic objectives. Policy, well, I found is helpful to look at integrating climate change into your business process and your protocols as well. So it's almost like a centralised way of looking at how the organisation is identifying and assessing climate risk. And I highlight on the right there some of the strategic benefits, such as risk pricing, capital allocation, etc. So ultimately, it's interesting. A lot of leaders in this space are realising the implications for brand, reputation, helping to meet stakeholder expectations, engagement. I think the critical area now of focus is engagement, for example, with customers. So it's moving away from actually trying to meet regulatory expectations into actually realisation you actually got to work with your customer base to help them reduce their emissions, work with suppliers as well. So it's that engagement that's really important. So that's sort of the end of my session and Stuart's first session. I mean, if we do have we just click on. If we do have any questions for Stuart and I after those two, for now, we will then I'll look to pass on to Alistair to give a regulatory update. Any questions for now? All makes sense. Excellent. So I'll pass on to Alistair, who'll give us the update from a regulatory, from the Bank of England's perspective. So thank you.
I take it the clicker is probably the best.
Yeah, I think we'll leave the clicker.
Okay. Apologies, I might need to use your help to jump between the slides in that case. While we're waiting, I'll introduce myself. So my name is Alistair Shepard. I'm the climate lead for insurance at the Bank of England. I've been back at the bank since September last year, having spent a number of years in stress testing and risk roles in the industry before then. I also need to start with a bit of an apology. I'd like to think of myself as naturally a bit more of a freewheeling speaker, but one of the disadvantages of being back at the Bank of England is while everyone is much more interested now in things I have to say, and certainly things I say publicly, it also means I have to be slightly more circumspect and scripted in terms of what I do say. So if you see me looking at my notes on my phone quite a bit through the speech, I promise I'm not checking out my own talk early. I'm just making sure that I'm giving you exactly the right lines and exactly the right bits of detail that you need to take away from this. I'll give it 1 minute while the slides come up and I'll get my notes up.
We've had to close down because yours were not on the island.
No, that's not a problem yet.
Combine the decks.
I'll give a bit of context to begin with while we're waiting for the full slides to come up. So climate change is obviously a key strategic objective for us at Bank of England. We see it as a really core part of our central mission of delivering financial and monetary stability. And lots of our work on climate is really centred around making sure the UK economy is resilient to the threats of climate change and the turbulence that we'd expect in any type of transition, orderly or otherwise. A core part of our work that is based around working with all of the stakeholders that we as an institution interact with right across the economy in partnership to make sure that the financial service sector and the wider economy is resilient and supportive of the transition to net zero, rather than likely to amplify risks that could crystallise along the way. Alongside that, we obviously do a lot of work with international central banks to coordinate action, to promote really strong disclosures, and to also think through innovative ways we as a central bank can start to cut down on our emissions ourselves. We jump on. I'll give you a bit of an overview. So I'm going to start off hopefully by giving you a bit of an overview in terms of our role and our work in this to date. I'll touch on some of the key publications like SS319 and really we deep dive a bit more on the Dear CEO letter that came out last year that I think probably was our most useful update to industry yet in terms of our expectations, how these are evolving and the precise things we want to see parts of the sector doing going forwards. And then we'll touch on some of the key thematic findings from CBES. Based on most of my interactions with firms to date, this has been an area where the industry I think got a lot of value and has a lot of continued interest in understanding the key learnings from. So apologies in advance if you've been a bit CBES to death on this already, but I think it's one worth dwelling on. I'll then look to draw out some of the key messages from our point of view from recent communications, like our early priorities letter this year, setting out climate change and the work we're going to be doing on this, and some of the findings from our climate and capital conference that I know some of you in your organisations will have fed into, and some of the ongoing work we're going to be looking to promote on this year and into the future. We jump forward and jump past the slide. So I think this is just really to give a bit of context for our engagement with the industry on climate change to date. As Martin and Stuart have both alluded to, our first kind of substantive foray into this was the work we did in setting out our expectations in SS319. These were deliberately reasonably high level and principle based, because from our perspective, the important thing at this stage was to facilitate engagement with the industry and make sure firms are starting to think through what good practice might look like in this space and work in partnership with us as regulators to make sure that collectively we were going on a journey to ensure that the financial sector would be resilient to the risks that could crystallise along the way. SS319 was followed up by work over kind of 2019 to 2021 from us that was all about helping to support industry to understand their expectations and to begin to work through some of the challenges that this would throw up in terms of evolved risk management processes and analytical capabilities. We knew that this wouldn't be something we could do alone, which is why we've worked with a lot of forums, including some of those alluded to by previous speakers, to make sure that it's a real partnership effort. And we've set out in letters in 2020 from Sam Woods, our annual report in 2021, and some of the wider work we've been doing up to the end of 2021, what we were expecting from firms before we started to move to actively supervise against it. 2022 marked a bit of a pivot point for us as a regulator, because this was the first year we started to actively supervise firms across the banking and insurance sectors in terms of how they're thinking about climate risk management. As you'd expect, we've looked to go about this in a really proportionate way. So the bulk of our engagement to date has been focused on some of the largest firms. But going forwards, as we'll touch on in some of the subsequent slides, we'd expect that to start to cascade down through the sector as we start to work with firms of all shapes and sizes to understand how they're developing and maturing their climate risk analytics capabilities. Jumping on to the next slide. The foundation of all of this, as set out, is SS319. For us, this is our key document in understanding how we think firms should be thinking about climate change, climate risk, and the ways in which it will affect their risk management right across the business. For us, this covers four key areas: governance, risk management, and scenario analysis, and disclosure. All of these, within the document, we look to set out key principles. These weren't looking to define at too granular level the exact ways in which we expected firms to be able to meet it, recognising that for each firm, the types of risks they're exposed to, their existing risk management approaches, and the new nature of the risk would mean that this was likely to be an iterative and evolving process rather than something we could dictate from the outset. But we were clear that in all of these areas, we'd expect firms of all shapes and sizes to be starting this journey and to be making progress at pace, because all four of these are fundamental to making sure that all of the firms right across the sectors have a good understanding of what climate change might mean for their business and are able to shape, understand and manage that in an appropriate fashion. If we, oh, I'll just wait for the slide to come back up. Across all of this, I think there's two important principles to stress. One, we've been very clear in the document and our supervisory engagement to date that our approach on climate risk is going to be proportionate. We would not expect good to look the same for any firm, let alone two firms of very different sizes. And so our supervisory expectations, while remaining true to all of these principles, will differ dependent on the size of a firm and its likely risk exposure in this area. That might mean, for example, that for a smaller firm, we might be more accepting initially of scenario analysis that was based on more qualitative elements, with quantitative elements only used for key risk exposures. Whereas for a large firm with larger risk exposures, as you'd expect, we expect quite detailed and robust quantitative monitoring right across their scenario testing to make sure they've got a really good identified and quantified grip on the risks they could be running. Alongside this, though, it's really important to remember that our interest in this is really tied predominantly and first and foremost to that core statutory objective of making sure the financial sector is remaining financially resilient. The wider transition, we know, is something that the government's got its own priorities and roadmap around, and as part of our due diligence and as part of the letter that we receive each year from our objectives, we're very keen to help facilitate the industry and the wider economy's transition in a way that's conducive to supporting that government agenda. But our objective as a regulator, first and foremost, is about making sure the financial sector is going to be resilient to these risks. And the Dear CEO letter that we can jump on to the next slide now, that we sent out last year, looked to update on the progress we thought the industry was making in this space. It was clear that we've seen a huge amount of work going on right across the sector in meeting our expectations, but it was also really clear that for every firm we've worked with, big or small, at the forefront or maybe more of a laggard in the space, there was more work to be done. Because no one in an area that's fast evolving of this is yet reaching the level that we see all of the sector needing to get to be able to adequately manage the full suite of risks that are going to crystallise, be they physical or transitional, as part of our move to net zero. I'm going to walk through in a bit more detail now some of the contents of the letter, because I think for the sector as a whole, this is probably the most useful guidance we've given today in terms of the specifics about how we think should be meeting our expectations. I'll start in a bit slightly with reverse order with disclosure. Now, this is because actually disclosure is probably the exception to most of the others set out on this slide. And that because our expectations around disclosure are predominantly quite principles-based at this stage, they probably evolved least since 2019. Now, this isn't because they're the least important. We actually see really clear disclosure of financial risks as fundamental to enabling the economy to transition successfully and smoothly to net zero. But within this, we recognise there's still a lot of moving pieces. Rightly, there's a lot of international work going on around understanding what good disclosure should look like in this space. I don't know, Sarah's speech a couple of weeks back set out the importance we see on speedy adoption of ISSB standards to help underpin a lot of this work. Alongside that, we also recognise that firms' own abilities to disclose these things effectively is currently constrained quite a bit by their own modelling and data limitations. And so actually for us, focusing on getting those right before coming in with more granular expectations around disclosure is really important, because we want to make sure that the sector and the wider economy can have great confidence in what we're asking firms to disclose before we're pushing too much on the specifics of exactly what they should be disclosing in each area. Governance. Here, I think our expectations set out in the letter got a bit clearer. We expect at this stage that boards and senior executives should have a really good grip on climate risk management and their firm's own strategy around net zero transition and the possible risks that could crystallise to them as a result. In practice, this means that we'd expect an SMF holder to be allocated with responsibilities for climate and to see that filtered down into their statements of responsibilities, and the whole board to have a very clear grip on the climate strategy for the bank, how they expect climate change to impact their forward-looking business planning, and how their governance arrangements need to change right the way through the lines of defence and committee structure to make sure that's managed appropriately. We'd also expect governance structures and those sitting on senior decision-making committees to have a good understanding of the risks that are being assessed and quantified by the business at this point, and also the limitations that are driving some of those judgments. So where firms are having to rely on proxies, on judgments and assumptions to overcome data gaps, we'd expect decision makers to be able to articulate clearly the limitations of those where relevant, and the sensitivities of key business decisions they're making to some of those gaps at the present time. Moving on to risk management. By now, firms should have a really embedded and articulate view of how climate change fits into their risk management framework. Now, for some firms, this might mean treating it as a standalone risk. For others, it might be a cross-cutting element of all of the other risks like credit risk, operational risk, market risk, that could crystallise. But at this stage, we'd expect firms to have that strategic level discussion and to make sure it's integrated into their risk management framework accordingly. We'd be really clear that we'd expect a nice, clear articulation within the risk appetite statement now about climate risk and how these are being managed within the business. This should be tailored to a firm's business model and strategy, and a clear link to the types of risks that are going to be most relevant for a firm, given its own unique business profile and its own unique risk exposure from climate, physical and transition risks over the coming years. We'd expect firms within their risk management framework to have a really clear articulation of what their counterparty engagement strategy is going to be. A big residual data gap and a big driver of a lot of risk in firms that we work with in the space is the exposure of their counterparties to climate and physical and transitional climate risk over the coming decades. We know that a lot of our firms are starting out on this journey, so we're not expecting a complete picture of understanding of all of their counterparties now at day zero. But we would expect that for all firms, they've got a clear roadmap to get the information they need to engage with all of their counterparties to understand their counterparties' risk exposures to climate risk, their business plans and how they, as a counterparty, are going to manage their way through the transition, and the business opportunities they might see. This is really essential to enable good decisions about what insurance markets to be entering into and exiting, to be able to understand what investments they're making, and to be able to understand and have a really good handle on the forward-looking risk profile of the type of counterparties that our institutions are working with, and not just their present-day one. Because we understand that with climate change, it's the forward-looking risk that is going to be important, it's going to crystallise, and that, as identified by CBAS, poses that big risk to some of our institutions' profitability. On capital within the risk management framework, again, as the climate and capital companies set out, and I'll come on to later, we're not looking to rush in to any judgments about what our formal capital framework needs to say and do about climate risk. But we are clear that, be it through ORSAs, ICAPs and other risk management processes, all the firms that we work with should be forming their own view on the capital adequacy of their firm with regards to climate risk, and taking actions accordingly to make sure that they're appropriately capitalised for the full suite of risks that this could pose. We'd expect ORSAs and ICAPs to have a really clear information to allow readers to understand the analysis of climate risk and capital, the modelling techniques used, their limitations, and plans to close some data gaps that could arise given the current challenges in the space that we know lots of the industry is facing. Scenario analysis more widely. We'd expect by now firms have really started to embed it. They should be able to assure their supervisors they've got a really clear idea of not just what their scenario analysis is telling them, but how it's then being integrated into their other risk management processes and business making decisions, so that it's driving useful and real-time risk management decisions rather than sitting on themselves as a separate piece of risk analytics. This could be helping to support and articulate the calibration of sector-level risk appetite statements. It might be looking to put in place limits on particular borrowers and particular sectors of borrowers that they then are looking to invest in. Or it could even be having a much clearer link into their strategic plan, to be able to shape those high-level board decisions about where they see their business viability going forwards. It's an evolving area, so we're not expecting, again, the complete solution to be in place at any firm now, but we do expect firms to be able to have a really good handle on what the limitations of their current modelling approaches are, and a roadmap in place to be able to articulate how those gaps are going to be closed out through time. This is something we expect to be discussed at board level to make sure that everyone is comfortable with the pace at which some of these analytics capability gaps are being closed out, and so that businesses have got a really strong handle on how they're closing the gaps in some of these capabilities to get to a stage where they can properly size and quantify the risks, not just to their business today, but to their business in the future under a number of relevant scenarios. Cutting across all of this, and probably an area that we didn't articulate much in SS319, but has really come to the fore in all of our work with the industry, is data. I've already mentioned it a few times, and that's because we know that data gaps and closing those data gaps is so fundamental to doing anything across the rest of this list effectively. Again, we're not expecting firms to have a complete picture of the data today, and we know that in places judgments, proxies and conservative assessments have to, and quite understandably have to, supplement data from borrowers and investees where they've been able to secure it. But we do expect firms to have a really clear strategy around how they're going to close those data gaps. linked back to that counterparty engagement plan to make sure they've got a robust view on how, between now and over a credible time frame, they're going to close out those data gaps to be able to get to a point where they can better assess the risks they're running. Where data gaps exist for now, we'd expect all of those adjustments that had to be made to be documented, and where appropriate and relevant, to being communicated in a way to decision makers that makes it easy for them to understand the sensitivities and the decisions they're making based off analysis that has necessarily for now be based on assumptions and judgments. I'll now move on to talk a bit more in detail about CBES, because for most of my conversations with the industry, I think this is one of our most interesting pieces of work that we've done, and it's one that I think has done the most to drag forward capability, working very much in partnership between ourselves and the rest of the sector. We could jump on to the next slide. I'll start off with the headline findings, which have already been alluded to by a couple of the other speakers. We ran 3 scenarios, no action, an early action and a late action scenario, across 19 participants to try and understand what their analytic capabilities could tell them about what these scenarios would mean for their businesses. As you'd expect, an early and orderly transition had the most beneficial impact, or had the most benign impact for our firms, with no transition having quite a steep tail end impact as we get towards the back end of the scenario, and a late transition having quite a steep impact at a point in time at which sharp decisions had to be made. The results, I think, are interesting and useful to understand as they help us start to size the risk and size the relative proportional impacts of different types of scenarios. But I think I'd really want to underline that we did not see the exercise as largely an analytical one. For us, CBES was first and foremost about driving capacity building in the industry. And all of these results should be taken with a pinch of salt, but there are a number of limitations that many of you in the room will be all too aware of that underpin them. So I'm going to bounce on to the next slide and talk through some of those limitations. CBES demonstrated that firms do face significant challenges from climate change, and we expected that, as all of you would have. But it also highlighted a number of the limitations that we know exist in the sector at the moment in terms of firms' modelling capability. It's quite likely, given these, that the CBES forecast of losses is going to be at the lower end of some of the risks that the firms are running. Partly because some risks are excluded, such as some of the modern trading losses on the banking book. Partly because necessarily where firms have had to use assumptions and judgments, we found that typically these assumptions and adjustments tended to suppress rather than add to the losses that were being forecast. So for a lot of the loss estimates coming out of CBES, the internal bank work suggests that these are likely to be at the lower end of expected losses, where these events to actually crystallise, because of the types of assumptions that firms are having to make to be able to carry out the exercise at this point. It also highlighted some eliminations of firms' modelling capabilities. As we'll jump onto on the next slide, lots of firms had to rely on third-party models to support their work for CBES. Again, completely expected and completely understandable given where the industry is on this at the moment. What's really important though going forwards is that firms don't place too much reliance on third-party models they aren't able to augment internally to fully capture the nuances of the risks they are running, rather than the generic bank or insurer. We don't expect all firms to have a full bit of in-house analytical expertise on this, but we do expect them to be able to ensure that there's a clear link between the types of models they're using, be they in-house or third party, and the risks they're running, and the way in which those risks are being modelled. And again, where there are limitations, we'd expect those to be documented and communicated in a way that's really clear to decision makers, so that everyone within the business can understand the sensitivity of the analytics they're creating, to the judgments that they're making to help underpin it, and the approaches they're using to carry it out. If we jump onto the next slide. Overall, I think from the exercise we took away that there's a lot of progress in the sector at the moment, but there's still much more we need to do, which was underlined by Sam in his CEO letter last year. There's really still quite a big gap in terms of analytical capabilities for us to be confident that firms can fully quantify and understand the true level of their exposures. We know that CBES was the first step for many participants in carrying out this work, and we're committed to continuing to work with the industry on this to make sure that collectively we're able to enhance capabilities and get to a position where firms are much better able to articulate the precise level of risk they're running. Data gaps, as we've already touched on, are a really common problem for climate risk quantification. We saw these in a number of areas, including firms' ability to obtain data on counterparty emissions, not just going forwards, but even just now. And for lots of banks, actually, we found that there were really limited data pools and quite fundamental things like EPC ratings, even in some cases flood exposure quantification but we know that we're going to need to work with the sector to push forward to make sure that firms have got a good understanding of those risks. And as alluded to, firms are very reliant on third-party models. Again, not universally a bad thing, but something that we need to work with the industry to make sure that all of the modelling approaches used is appropriate and nuanced enough to both be able to capture the wide range of risks posed by climate, but do so in a way that's suitable and appropriate for the specific business model they're being applied on. I also want to touch very briefly on the seabed litigation exercise. We jump on to the next one. This area was, I think, probably the area where progress in the industry at this stage was most nascent, and the work we were doing to model this and to work with parts of the sector to model this was most innovative. So from our perspective, I think it's one of the areas we found most useful in really trying to drive forward focus and progress in the industry, understanding the risks. We looked across 7 hypothetical claim scenarios, which are set out in the full CBES documentation and are well worth thinking through if you're looking as an insurer to understand your own risk profile in the space. And it came up, and it really, I think, drove home for us a few key findings. One, it's pretty clear that at this stage, to be able to fully understand climate litigation's impact on business models at the moment, there's going to have to be significant further investment in data collection, exposure modelling, and scenario development. For most of the counterparties we worked with, it was the first time they'd really ran climate-style scenarios across their book. And as you'd expect, they came through a huge range of problems in doing so, not least in trying to pull together the policy wording through a wide range of myriad and often quite bespoke and unique policies to understand the real risks that they could be exposed to in the space. We worked with a lot of London market GIs to help develop data extracting and modelling techniques to ensure that they can try and carry this out on a more regular basis going forward. But we're aware that this is a real area for progress going forwards. And so we welcome moves like Lloyds' consideration of whether this should be one of their RDSs going forwards to make sure that right across the sector, which is underwriting risks, which could be exposed to litigation as part of climate change, there's a better ability to size, understand that, and also understand that there's a clear link between coverage and the intent of the person taking out that coverage. Because again, as we were going through some of the testing some of these cases with some of the firms that we were working with, there were clear deliberations and debates about whether actually policies were truly capturing the intent of the policyholders. Finally, we're aware that off the back of this, there's a huge amount of work that GIs are still doing to capture and review their policy wordings. The challenge of operating the subscription market, I think, is one we certainly note as part of the results, and we're really keen to work with the industry to continue to push on their work in this space to make sure that we're really continuing to enhance it. Again, as I alluded to at the end there, it was very much a capability building exercise. So we welcomed, I think, the discovery of lots of these challenges. We were expecting them. We really appreciated the extent to which the industry attacked them head on with us. And we're committed through our supervision firms to continue to work with the sector to close them out. I'm aware I've been talking for quite a while, so I'm going to rush through very quickly my last slide now, which is just a quick summary of some of the key recent communications and some of the take-home messages from the sector going forwards. Firstly, on the insurance priorities letter, which is mirrored, I think, very closely the letters used to banking counterparts. So is really relevant, whatever sector you work in that we regulate. This year is really a year of continued progress in the sector and continued supervision from us. As alluded to, you're likely to see us starting to work our way down the food chain in terms of the types of firms that we're engaging with on climate risk. And you can expect us to continue to engage for our BAU supervision, but also a number of thematic reviews across the year to test and understand where firms are at, based on our communication last year and based on our evolving understanding of where the industry needs to get to. The Climate and Capital Report, which came out earlier this year, also gave, I hope, a really useful update in terms of our latest thinking. We're hugely appreciative of all of the work in the industry that went into helping to make our Climate and Capital Conference the useful and comprehensive debate that it was last year, and a huge thanks to anyone who helped contribute to that. I think for us, it clarified both a few things that we can start to make judgments on, but also some areas where we know that we recognise further work's needed before we can start making any decisions. As I said at the start, it's not something we want to rush into. We want to really understand the nature of the problem and the nature of any gap within the capital framework before moving to setting policy against it, rather than rushing in with any blunt tools. It's set out in there and then left some of our thinking. Understand that probably actually the current capital framework time horizons look like they're likely to be adequate. But given the forward-looking nature of the risk, stress testing is likely to be a key tool in any decision making we get to around capital and climate risk, to make sure that it's robustly backed up by firm analytics and a grasp of the size of risk we're talking about. further explanation of all of these risks is going to be really important. So before we move to any policy making on this bit planning, and we'll be continuing to engage with industry stakeholders right across the sectors that we work with, and I'm sure many people in this room, to help better clarify and understand whether there is any policy gap, the types of tools that we might want to use to close it. But in the meantime, we should really want to underline that this should not be seen as supplementing or preventing firms from meeting our expectations, that they should have their own view on how adequately capitalised they are for climate within their ICAPs. And they shouldn't be delaying firms from making their own judgments within their risk management processes. I'm mindful that I've talked quite a while, so I'm going to wrap up there, but I hope that's been useful. I will be very much sticking around at the end if you've got questions or scrapping on anything. Thank you.
That was excellent. Thank you very much, Alistair. Any questions for Alistair from the audience? We can leave those to the end. I think we'll carry on. I'm going to welcome Susan Young, who's actually on our climate risk committee, given the practitioner's perspective experience.
Thank you,
Susan.
Thank you, Martin, for the authentic introduction. And yes, this is going to be a practitioner's perspective. Absolutely delighted to be here to share some of my thoughts, comments and experiences. And those of you who are also practitioners, I hope that a lot of what I'm about to say will resonate. I expect it probably will. So is this not
We're just loading up. We're just loading up the
right
the slides to make sure we have to stop sharing the.
Right. Okay, so these are the things I'm going to cover in this presentation. Should take about 10-15 minutes. So first of all, my credentials on this subject and a bit of a disclaimer as well. Some practical challenges that certainly I've experienced and some of you may have experienced as well. I'm going to talk a little bit about TCFD because we've been using this a lot in our business as our framework. I'm sure some of you have done that as well. And then a little bit about building a climate risk management framework using TCFD, some practical considerations, risk identification, some examples from our industry, and some notes about some other information that we need to capture. Some additional thoughts at the end, and then some. I'm just going to sort of wrap up. So next slide, please. Thank you. So my credentials is that I'm the Chief Risk Officer for R&Q Insurance Holdings Limited. So I'm in the insurance industry. I hold the SMF4 Chief Risk designation for our PRA and FCA regulated entities because we've got a few of those in our group. I'm also the Senior Manager responsible for the financial risks of climate change, so I have that designation as well. But we are an international group and we have other regulators, the multi-jurisdictional, so our reach is further than just the PRA and the FCA. As Martin said, I'm a member of the IRM Climate Change Special Interest Group, but I also have a very personal interest in this because I'm a flood victim. My home was flooded by the Thames in 2014, and I do quite a lot of work voluntarily in the property flood resilience space as well. And I'm a member of the UK Property Flood Resilience Roundtable, which is coordinated by Flood Re, and I'll be speaking at the Flood and Coast Conference in a few weeks' time. So, next slide, please. Interestingly enough, Chris Whitty, who says that quite a lot, he's a very distant relation of mine. That's my maiden name, Whitty, and he's. So maybe I've got that from him. Next slide, please. So, okay. So some. Yeah. Some practical challenges. Oh yeah, something I did mean to say is that these views are my own as well, so they don't necessarily reflect those of my organisation, but they're very much my personal views and experiences. So a few challenges. So you could ask yourself the question, just one of many things that we need to think about from a risk perspective. You know, how do we prioritise this and where do we start? My view is that climate risk from a practical perspective was kicked down the road during COVID. So in a sense, the formation of the climate change SIG was really quite fortuitous because it meant that we could actually get some impetus and momentum behind us. You could ask the question, is this not just part of ESG? You know, haven't we already got it covered? Well, to a point, yes, but I think it's very much a very big area in its own right. There's got lots of thought leadership out there, a lot of science. It's far too technical. I think that's a concern that we might have. Understanding the relevance to our organisation. You know, we're in insurance. You know, we've just got officers. We don't have a lot of carbon emissions, or do we? And there are all these frameworks out there. So what should we subscribe to? I think that was on one of Stuart's slides earlier, wasn't it? All of these frameworks and all of these external stakeholders that have got some skin in the game on this. You know, and how do we manage the plethora of regulatory requirements? I think, as I said earlier, we are multi-jurisdiction and we get all sorts of different data calls in all sorts of shapes and sizes around climate change. So coordinating that and making sure that we have the right approach and a consistent approach. We've heard a lot about data collection. That's a really, really key issue. And, you know, the timescales are very long. You know, how do we get our boards interested and how do we keep them engaged in all of this? You know, particularly if they're just thinking about the next deal that they're doing. You know, climate change, that's not going to happen for decades, is it? So these are just some practical challenges that that I think I faced, you know, certainly as we were getting ourselves started with all of this. So just moving on to the next slide. This is the TCFD. I mean, you'll all be familiar with this, so I won't go through this. But I'm just setting out really what TCFD is, when it came into effect, and who it applies to. And actually, it dovetails very nicely with SS319. There's a lot of similarity there. And so, you know, we've obviously been using SS319 for our UK regulated entities, but TCFD is informing our wider climate change efforts. By the way, I thought that dear CEO letter was enormously helpful. It really was. Yeah, we all thought that was really helpful. So thank you for that. And we're not just applying it to our UK regulated entities, but also across the piece as well. So thank you. So, you know, we've really used the TCFD as our linchpin in our approach to putting a framework together. Onto the next slide, that really just talks about the 4 pillars of TCFD. There's the 4 pillars of SS319 as well, but, you know, we've got governance there. And that was in SS319 as well. Strategy, and I think this is where I think boards really need to get it, is that, you know, we need to understand the actual potential impacts of climate related risks and opportunities as well. It's not all about downside to our business strategy and our financial planning, etc. Risk management, clearly we've talked a lot about that, and metrics and targets. You know, what metrics are important to us, you know, what's going to be meaningful, what's going to add value, and where we're going to get the data from, you know, and how we're going to, I suppose, police it and make sure that we keep it current. Next slide just talks about physical and transition risks. I'm assuming that everybody knows the difference between the two of those. I've just included them in my presentation for completeness. So just moving on to the next slide, which is a schematic that we put together, which is building a climate risk framework using TCFD. So using the pillars and using the various elements of it. So, you know, starting from the top left, we've got our governance and oversight. That's kind of where we need to start with our boards, with our management, to make sure that we've got the right frameworks in place and the right buy-in as well. Then we move on to identifying and assessing the materiality of our climate-related risks. So understanding what they are, and what, you know, in terms of what the downsides are, what the upsides are, etc. And, you know, what our stakeholders might be interested in and what's important to them. And in our ESG efforts, that we certainly went down that route as well. Developing and defining our scenarios. You heard Alice talk a lot about that. That's kind of the next stage. Evaluate our business impacts and identify our potential responses. So just good old fashioned dyed in the wool risk management. You know, we've got our risks. If they're outside our appetite, what do we need to do about them? So nothing really sort of new in any of that. And then the documents and disclosures again, which you heard Alistair talk about. Those arrows are in there really to demonstrate it's very much an ongoing and iterative process. We don't just start and stop with putting our framework together. We need to kick the tires on it on an ongoing and consistent and a continual basis, as we do with all of our risk management efforts as well. So that's our framework. That's a suggested framework. You know, you may have something similar to that. You may have something a little bit different. But just moving on to the practical implementation. So in terms of building out a climate risk framework, somebody mentioned earlier that this is very much a journey. I think that might have been you, Alistair. It's very much a journey. It's going to develop and evolve over time. I think commensurate with climate change and its associated risks and opportunities. I know it's a cliche. Start with your board. Understanding and tone has got to come from the top. Embark on an education programme. We did a lot of this, certainly with our UK regulated entities, about SS319 to start with, you know, because our other SMFs, they need to understand what their responsibilities are. But we took it wider than that as well. So we do a lot of bite-sized education as well. So, you know, that needs to develop and cascade as we progress as well. Don't reinvent the wheel if you don't need to. Look at what you already have in your risk management toolkit. And what we did is we looked at our emerging risks process, because there was a lot of good stuff that was already in that. The chances are climate change is or was in there. So use that as a starting point. And perhaps conduct some multidisciplinary deep dives into climate change to understand the risks and the opportunities as well that exist within your business. So when we did that, you know, we did it in the context of our emerging risks focus group, and we took climate change, and we had people from investments, people from our underwriting, from our catastrophe risk side, as I said, investments, didn't I? Our credit risk side, our reinsurance, and our operations, and you know, we've got a very good sort of suite of climate related risks there. So I think a lot of it, from a risk perspective, from a risk practitioner's perspective, a lot of it isn't really rocket science in terms of process. It's largely common sense, but you know, we were able to use our own existing risk management framework and methodology, and we were able to adapt it and sort of build on it. Next slide, please. So in terms of risk identification, as I said, you know, you can leverage it from your existing risk framework. These are some risks that we've identified. So, you know, increasing regulatory scrutiny. These aren't in any particular order, but obviously that's a key one there. If you've got catastrophe exposed business as a general insurer, that can be an opportunity as well as a threat. So have we got the modelling capability of the data, and is it updated with the latest information, and modelling on standard and warm seas basis as well. Have we acknowledged what our underwriting risk appetite is around underwriting and reinsurance? Does our due diligence procedures for our counterparties and our supply chains take climate change risk into account? Are we, you know, how far down do we go in our distribution and supply chain channels is also it's a key sort of I suppose consideration, but we need to understand the people that we're doing business with. Are they taking this seriously as well? Business interruption from physical risks. You know, are our business continuity plans sufficiently robust? Now, the next one's quite interesting. Attraction and retention of staff. I think it was mentioned earlier that a lot of our younger cohorts are very interested in what we're doing from a sustainability perspective. And certainly in our organisation, a lot of them are asking us about it at interviews as well. So yeah, people are interested in this stuff, you know, from a personal perspective as well as a professional perspective. So, you know, that's if we're not seen to be taking this seriously, then that could be a risk as well. Understanding our carbon footprint, well, I guess that's a given, and our reputational risk if we get this wrong. Investment portfolio risk, you know, we've got a big investment portfolio, so do our investment managers get this as well, and do they understand what our strategy is around all of this? So that's just I suppose a snapshot. It's just some of our sort of big ticket items that we're looking at the moment. So there are, that's what we've identified. There's a lot of other information that we capture as well, we should look to capture. So the next slide, please. So, you know, the major aim really is to assess the resilience of our business strategy to climate related developments. You know, we've seen the threat of litigation rising over recent years as well. So that's another key thing to take into account. We need to identify whether it's a risk or an opportunity or both. You know, is it an upside risk or a downside risk? Is it physical or transitional? I suppose that's a given. Identify clear owners and actions as well. It's all very well, I suppose, identifying what our climate risks are, but we actually need to be seen to be doing something about them as well. Rather than probability, we look to measure timeline to crystallization. It's probably more appropriate than a traditional assessment of probability. You know, do the risks require immediate action, monitoring, or business as usual? And are our current mitigants, are they likely to be fit for purpose in 1, 2, or 5 or 10 years' time? You know, we're looking at very sort of long sort of time horizons with all of this stuff here. So that's just a few of the things that we need to capture when we're building our risk universe from a climate change perspective. Just moving on to the next slide. I'm almost done. Just a few more slides to go. So as a practitioner, you know, elements of climate change are going to continue to evolve, so we need to keep on it. The impact of climate change on business are more pervasive than one might think. Make sure that you identify and engage subject matter experts across your business, because this is, as I said, this is very pervasive. Identify what's important to you as an organisation. Try not to be too blinded by the science. And I'm not saying that the science isn't important, it is, but you know, you need to sort of sometimes just take a very pragmatic view and decide what is important to you. You know, keep its profile up. It's not just a tick box exercise, and make your efforts relevant to all. It's everybody's responsibility. We're all impacted personally as well as professionally. And TCFD aligns with many other reporting requirements. It's going to become quite prominent in the future as well. Sorry, I should say TCFD, not TCFR. Final slide. I said at the start that climate change is very much a journey, and the ongoing management of climate and the ongoing management of the climate risks that we've identified. I think the end game from a risk perspective is that it should be seamless and embedded within existing and established risk management frameworks. So we don't really want to make a cottage industry out of it. You know, if it's actually working properly, it should be embedded into our hearts and minds. And I think we as risk professionals, because of our the perspective we have, we are in pole position to facilitate this journey, given our understanding of and exposure to our organisations as a whole. So I think it's a great opportunity for us to really show our value here. And I think really the final thing that I will say that is not in my slides is that climate change resilience is very much a mindset, you know, and that's I think where the journey comes in, because I think that's those sorts of things take time to embed and to crystallise. That is all I wanted to say. That's a wrap from me, unless anybody has any questions.
Yeah, I have a question for you, Susan, but it kind of follows on to one for Alistair as well, if you
Of course, not at all.
So my name is Simon Hillard. My question relates to the first line of defence and dovetailing in with opportunities. And I was really pleased that you brought up opportunities, because for lots of people, There's a big sigh when we hear about climate change and
Yeah.
ESG, and it's a bit of a pain for everybody. But I think it's absolutely essential the first line of defence gets involved.
Yes.
I think the way to do that is by looking at the opportunities. I'd really like to understand from your perspective how practically you get your first line involved, excited about this from an opportunity perspective. And then equally, I'd like to hear from Alistair how, from a regulatory perspective, you look at it from a first line of defence perspective as well.
Want me to go first?
Yes, thank you.
Yeah, the way that we pick it up with the first line is, I mean, I did say earlier that climate change is very much a subject in its own right, but it is obviously the main E in ESG. So I lead the climate change work stream as part of our wider ESG efforts. So we've got an ESG working group, and we've got people from across the business involved in that. So particularly on, I suppose, on our underwriting side, you know, we do write a lot of catastrophe exposed business in the Gulf and around the world in Europe as well. So, you know, we've very much got our underwriters involved. So it's not just a question of managing our exposures, but seeing, you know, if there are any opportunities where, you know, there's, I guess, this is just one example. This is just the underwriting example, without taking too much risk outside that's not within our appetite. But, you know, is there an opportunity for us to write business that perhaps other insurers aren't writing? Maybe not now, but say sometime down the road. So we've got our underwriters involved, we've got our investment managers involved as well. So, you know, tactical investments, investment opportunities, those sorts of things. Making sure that obviously that our investment managers are aligning with our what our appetite is. But it's involving them all in the ESG journey, I guess, is how we do it. And you know, we've identified some opportunities, but there will be others that we probably don't know about yet, which will come sometime in the future. Does that make sense?
Yes, that does. Thank you. Yeah.
And I guess just to follow on, absolutely right to highlight opportunities. And I think we've been clear in lots of our publications and analysis that we see where firms are better able to kind of identify, understand and articulate some of the opportunities from this. That tends to be a sign of sophistication, doing lots of these things in a slightly better or more nuanced way than some other parts of the sector might be able to at the moment. I think we certainly wouldn't want to dictate what first line looks like. So it's for each firm within their own risk management processes, within their own model and operating approach to dictate how it's shaped. But I think one of the valuable hooks I think we've probably seen and that tends to work well is making sure that the first line is really involved in some of the assumptions work around scenario testing. So making sure that expertise is really leveraged to understand for individual business lines what these scenarios might mean, both from a risk perspective, and so when the kind of risks there, that the kind of arise for their business, that where their expertise is relevant, that they're very much involved and it's not taking place in a separate silo. One, we tend to find the risk analysis then tends to be much better and more granular. But also from an opportunities perspective, I think a lot of the good practice is actually being able to taking these people into opportunities where they can actually put time to think about what these scenarios might mean for the business and where they may be able to profitably generate business opportunities going forwards. And so involving first line in a more direct way in some of the scenario testing process, both from a risk quantification point of view, but also an opportunity scanning perspective, I think has been a useful hook. Though it's far from the only hook and far from the only example we see. And obviously it's one where we wouldn't want to dictate one way of doing it to firms, but it's certainly something that we see work well.
Thank you. Yeah.
Thank you very much, Susan. Just to point out, I've been involved, luckily, like 2 years ago with ClimateWise, which was an industry, that's the point that Simon raised, industry project, looking at how the insurance industry can move to net zero. So there's a lot of engagement now, and also a lot of people involved in that project were actually underwriters, as Susan mentioned, actually getting into the first line, think about areas such as product innovation, gaps in the market, etc. So I think there's a realization that you do need to engage the first line, actually running workshops. You know, something better than running workshops with different stakeholders, especially with developing scenarios. So the last two presentations, I think, we'll come up with some more practical case studies. We've got Stuart will give some examples in the banking sector. Now, follow up with, definitely we'll talk through some of the product innovations we're seeing in terms of risk transfer solutions, which I think is a really interesting subject. So I'll pass on to Stuart.
conscious of time.
Tom, I know, we're
Before
on
we
now.
wrap up, I know. Right, so I'll be relatively quick as I can. So I'm going to talk about climate resilience strategies and then have a few case studies focused on the banking sector. And we've heard of Susan. She's kind of nicely kind of defined what climate strategies are all about, and it's about obviously understanding risks and opportunities for your particular business. And why is that important? Well, I guess firstly you want to understand the impact climate change can have on your business model, and we use a lot of stress testing to understand that. And that's really important because of safeguarding your firm against financial loss due to climate change is really the kind of key priority in that one. And then the second piece is understanding the impact of your business model on climate itself. And when we think about that, we're thinking about actually what are the emissions across your organization, scope 1, 2, and 3. What does that mean from a baseline perspective, and then how do you decarbonize? And so maybe if we move on to the next slide, which kind of outlines what a climate resilience strategy looks like.
So
Oh, maybe I can do.
I've just realised we'll have to rush through and maybe just sort of cut down to a few minutes and.
Correct, yeah. Sure.
Load up again, or we lost the connection. Just maybe,
Yeah, if you just bear with us, we're just updating.
pass along. Apologies, we're just trying to sort out some.
They can see on the call.
We can see on the call, but we can't see on here.
So there's something
Want to use your that screen?
No. Is it possible to take it down and put it back up?
Yes, I did that.
We stop sharing.
I don't think it's
I know, it's always the way, isn't it? Can you disconnect from the screen and reconnect?
It's an internal cable is this one.
Internal cable.
Because they can see the lights in the screen.
Use. People online can see the script slides. I don't know whether if you just sing, do you want the slides, and then we'll just have to listen to you maybe just go through the slides. Is that okay?
Yeah,
Without being on there, but
yeah.
but it's being recorded with your slides. That makes sense.
That's fine. I can
Yeah.
I can continue, maybe you can get it. Right, the next slide I was going to go through, or the slide that probably is up on the screen, is just there's kind of 6 key elements, I think, to climate resilience strategy. I guess the first 3 of those largely linked to the impact of climate change in your business model. And so what we're seeing in terms of how do you define a climate resilience strategy, well then it focuses on 3 things, as I said, which is conducting scenario analysis and stress testing, and that's quite a large ask in itself. Secondly, it's about setting a strategic foundation implementation, so a lot around data and system implementation on climate, and then it's more around the governance framework. So what is the 3 lines of defense, the risk registers, risk identification, how do you link that all in with the risk appetite statement? There's another element then which is around emissions. So it's financed emissions, so it's understanding what your financed emissions are and baselining that across scope 1, 2, and 3. We probably all know that scope 3 is by far the largest for an FS client, or for an FS firm. But then the important piece is once you baseline it, you need to get to net zero. How do you decarbonize? It's determining a decarbonisation strategy that allows you to reshape your balance sheets, decarbonising assets, and ultimately maintaining the key metrics that your board is focused on around profitability, capital requirements, liquidity requirements of the firm. And then we've spoken a lot around reporting. So then getting your reporting right, that you meet your TCFD, ISD, CSRD requirements. I was going to go through some 3 case studies, but maybe due to time I'll keep it short and maybe just focus on one.
Just 1 case study, that's fine. Yeah.
I'll just do one. So I think, oh, here we go. So great. So so this is a case study which is a stress testing case study, and it's where we supported one of the UK Tier 1 firms on the CBA stress test. And in effect, what we were asked to do was to come in and support the firm end to end, and that was from understanding the data and data identification and sourcing the data, all the ways to engaging with the board and the reporting that went to the board. And so what we kind of did was we set about firstly starting with the 3 PRA scenarios, as Alistair pointed out, early action, late action, no additional action scenarios. And then we looked at understanding the bank's key portfolios, their global footprint, what were the vulnerabilities that sat across their business, because it's really important to focus on what the key portfolios are actually could potentially be subject to climate risks. And then we took the step in terms of building out that modelling capability. So firstly, we built some physical risk models, and then we built some transition risk models that allowed for a better understanding of the particular impacts from the scenario onto aspects like PD, LGD, ECL impairment provisions, and so on. To give you a little bit of a flavour of what that looked like, maybe we step on to the next slide. So what this slide focuses on the physical risk modelling that we supported the client with. On the left, graphically on the left, you've kind of got a visualization of a physical risk in 2021, and I think this is a flood risk peril. And then the objective really is on the right. The Bank of England has given us a view of flood risk across the UK. And we need to basically understand or determine what does that ultimately mean in terms of the impact for the bank itself on its property related assets. So as part of our methodology, there's really kind of three steps, right? Inputs, the quantification piece, and then the risk impact assessment. In terms of the inputs, predominantly this is around the portfolio inputs on counterparty data, the property related data in terms of collateral values, property locations, and so on. And then there was the scenarios from the Bank of England and any expansions that we conducted on specific physical perils. And particularly in this case, it was flood risk, coastal erosion, and subsidence, because it was UK assets. Then we kind of move into the physical risk quantification. That in itself is, to start with, it's a geospatial mapping of all the properties in the portfolio to longitude, latitude locations, and then mapping of that onto the scenario itself. So you've got that kind of interlinkage, and then thinking about actually how do flood perils change across different data points on longitude and latitudes. How can we then translate that into an adjustment to the property value? And that adjustment comes via damage curve modeling that ultimately allows us to stress to some extent the collateral value and then come up with an adjusted loan to value for that particular property. We can then use that to feed into the typical risk parameters that we would typically manage a bank with, which were PD and LGD measures. And notwithstanding, obviously, there's other aspects like property resilience that we also consider within this. But ultimately, we use that to determine an ECL value and produce an impairment. But that was just one case study that we had where we work with a bank to deliver that kind of end-to-end capability. And I guess I'll probably stop there, actually, given the time frame.
Yeah. Thanks a lot, Stuart. I think that's a really helpful example, showing sort of, I suppose in a way the complexity, but also the importance. But here, obviously, you're trying to help the company understand the impact on its impairment provisions. But obviously, there are other benefits looking at pricing and product design as well. So there's a lot of potential benefits there in terms of credit risk management. Just want to, just while we've got Geffen here, I didn't realise the time had slipped away. So Geffen's presentation is relatively short, so
I'll keep it brief.
I'll keep it brief. Sort of cover a couple of case studies, which I think this is very interesting presentation in terms of product innovation, and sort of leads into sort of some of the work that we've already explained today.
Yeah, thank you. I'll keep it quick. Well, firstly, thank you for the opportunity to come and talk to you all today about parametric insurance. So you can. So my name is Geffen Jones. I'm one of the two co-founders of Skyline Partners, which is a insurtech focused solely on parametric insurance. So founded the company back in 2017 with my colleague Laurent Sabatier, and we look at the opportunities presented by the ever increasing availability of data, the use of technology to create new types of risk transfer using parametric insurance model. So what is parametric insurance? Some of you probably aware, but for those that aren't, so it is quite different to a traditional indemnity insurance. It's not a new concept. It's been around a long time. I think in the sort of cat bond, catastrophe bond market. For governments, probably way back to the 1990s, but it's becoming more and more used in sort of more mainstream application. But the key element of it is that it pays out based on an event occurring as opposed to a loss being incurred, and it's still insurance. It's still an insurable interest. But what you do is at the underwriting stage, you quantify what that loss will be when that event occurs. So what that means, it becomes a very efficient way of insuring and getting payments out at that time of need when that event occurs.
The case studies would be click forwards, forwards.
Yeah, but I think it's worth just focusing on this very quickly. So the key benefits of parametric, obviously, and what why is it relevant to climate risk and resilience? So it's a very quick payment. So and it's data driven, so it can be used in emergency response type activities at the time of need, or even ahead of the need. Given it's data driven, it can be used using forecast data. So the insurance can be paid out ahead of time to put in the necessary actions ahead of a flood or hurricane or etc. It's completely transparent. So the data that's being used to calculate the claim is available to obviously the client, the insurer, everybody in the chain. But most importantly, it can cover non-physical damage. So given the world is becoming more value in intangible assets as opposed to physical assets, and traditional insurance is really targeted at covering physical assets and losses relating to physical assets. Parametric, given the nature of it, it's being paid out on the event occurring. You can correlate it to intangible losses, increased operational costs, supply chain disruption, business interruption that's happened where you haven't actually had a physical loss, a physical damage to your own assets. So again, a great tool for these emerging risks. Really, it can be the indexes that can be used. It's really anywhere where you've got the data available to the sufficient quality, frequency, availability, and here's just some examples of some of the parametric products we structured and that are available. Generally, they've been traditionally targeted, as I said, at NatCat, natural catastrophe, and agriculture risk, but more and more applications to more other industries as well, and beyond climate as well, like cyber risk, terrorism. These type of risks can also be covered using these type of products. So first case study. This is a product that we developed, which was backed by Munich Re for credit unions in Jamaica. Again, coming back to that non-physical damage element. So, if a hurricane hits Jamaica, there's obviously the risk of default on the loans from the credit union for the farmers, but also at the time of an event, the bank will need liquidity to offer more loans. So what this product does is it pays out based on the category of the hurricane, fixed payment at the time of the event, as soon as that data is available, given to the bank, and then the bank, the credit union, offers loan holidays to the underlying loanees. So there's a benefit there, so that the insurance is funding the loan for the period. So it's a benefit to the loanees, but also to the bank, because they've obviously got the cash quickly and can offer more loans as well. So a great example of a parametric application, non-traditional. And then there's one more case study. I'm trying to keep it quick. So, yeah, and this is another product that we've launched to do with heat stress, and this is actually targeting the agri industry in France. So we launched this in 2021. Apparently, heat, cows don't like heat. Who knew? But it affects their milk yield. The amount of meat that they're producing. So again, if you've got a mortality, the cow actually dies, there's insurance available. If you're losing revenue because there's a heat wave and your cows aren't producing milk, then you've got a loss. Parametric, again, great application of this type of structure. So we covered a portfolio of farms across the whole of France by an agri-tech company that was offering this out to their customers. Launched it in 21, very cold year, no claims. Last year, it was almost full limit payout, across the whole of France. And we're just launching this actually in the UK with the National Farmers Union Mutual. So you know, watch this space. You'll see this in the UK soon. So you know, a couple of case studies. You know, looking at climate risks and these sort of non-physical damage elements, which traditional insurance doesn't work. But these parametric products, in conjunction with the traditional insurance, is a fantastic tool targeting climate resilience, particularly in the sort of mitigating actions as well. Just to note before we wrap up, I think the funding of services or actions ahead of event as well, which I talked about, like a flood, is again a fantastic use case for these products, and we're currently working on some of those applications at the moment. So yeah, I hope that was quick enough, Martin.
Thank you very much.
Bob, questions?
Probably had
I'll
too
be
many
available.
good speakers and a lot of content today. So thanks for your patience, and thanks for staying on there online. And hope that you all found it very interesting. Obviously, some of the new solutions are very innovative, and the actual applications are quite broad there. But anybody got any last questions before we finish, and then we can have some drinks outside for the people that are attending. Anybody online? I know probably some people did actually. There were some chats there. I don't know, Shiva, probably if there's anything that came up there that we wanted to answer.